Today, we're diving into a document that's pretty much a masterclass in business and investing all on its own. It's Warren Buffett's 1982 letter to Berkshire Hathaway shareholders.
So, the story kicks off with what looks like bad news. In 1982, Berkshire Hathaway's operating return on equity was just 9.8%. Now, to put that in perspective, that was a huge drop from the year before and way off the recent highs.
For just about any other CEO, a number like this would mean it's time to panic, or at least make a lot of excuses. But what Buffett did next was completely unexpected, and it gives us our first big lesson from this incredible letter.
He basically said, you know what? This yardstick we've been using, return on equity, it's broken. He actually threw out the very metric he'd been championing for years. So let's get into exactly why he did that.
First, we'll see why his favorite yardstick just wasn't working anymore. Then, we'll get into the massive difference between accounting reality and economic reality. We'll explore what he calls the commodity business trap, and finally, cover one of the biggest mistakes a CEO can possibly make.
All right, this is where we hit Buffett's first huge lesson. You have to understand the massive difference between the profit a company says it made and what it actually earned in real economic terms.
Accounting earnings, that's the number you see in the headlines. It follows all the official rules, but Buffett points out that those rules can hide a huge piece of the puzzle, especially when it comes to a company's investments.
To really see what's going on, Buffett says we need to look at economic earnings. Now, this includes a company's slice of all the profits from its investments, not just the cash dividends it gets, but also all the money those companies keep and reinvest in themselves. That, he says, is the real measure of an increase in value.
In this example with Geico, Berkshire's cut of the money Geico kept and reinvested was almost 7 times bigger than the dividends they actually got paid. But because of accounting rules, that $23 million in real profit was completely invisible on Berkshire's books. It's crazy. As Buffett said, Geico could have earned another $100 million, and as long as they kept it, Berkshire's reported earnings wouldn't have changed one bit.
So the big takeaway here is that you just can't take those reported earnings at face value. They can give you a warped picture of what's really going on. And that's exactly why that 9.8% number was such a flawed way to measure Berkshire's performance.
Now, this whole idea leads us right into the next lesson, which is all about the kind of business you're dealing with. Because as Buffett explains, not all profits are created equal, not by a long shot. He lays out this brilliant, sharp contrast. So on one side, you've got businesses with real brand power, like See's Candies. People walk in and ask for See's. That gives them power over their prices. But on the other side, you've got these commodity businesses like sugar. I mean, nobody goes to a cafe and asks for a specific brand of sugar, right? In those industries, price is the only thing that matters, and the competition is just brutal.
And Buffett saw the insurance industry as a perfect example of this trap. He saw it turning into a commodity. Just look at this table of the industry's combined ratio. But if that number is over 100, the industry as a whole is losing money on its basic business. It's a total downward spiral, all because of savage price competition.
In these kinds of industries, even the good times are dangerous. Why? Because as soon as things get profitable, everybody gets excited and rushes to expand. And what does that do? It creates way too much capacity, which leads to another price war, and the whole cycle of losing money starts all over again. It's a vicious loop where success actually plants the seeds for the next failure.
All right, this brings us to Buffett's third big lesson. A huge warning about one of the most destructive mistakes a CEO can make, making bad acquisitions.
He noticed that in so many takeovers, what he called managerial adrenaline just took over. The excitement of making the deal, the desire to build a bigger empire, it all just trampled over common sense and basic financial logic.
And then he breaks down the math, and it's so simple but so devastating. Let's say your company's stock is selling for $1, but you know the business is really worth $2 per share. Well, if you use that undervalued stock to buy another company, you are literally trading away $2 of real value just to get $1 of value back. It's an obviously terrible trade, but he was seeing it happen all the time.
Then he just humorously tears apart all the typical excuses managers use. They'll say things like, oh, but the company we're buying will be worth so much more later, or we just have to grow, or they try to downplay it. But as Buffett says with that classic wit, it doesn't matter if it's a small dog or a big dog messing up your lawn is still a mess. A little bit of a bad deal is still a bad deal.
You have to be really, really skeptical of advice from people who get paid when the transaction happens, regardless of whether it's actually a good move for you.
Okay, so after all of that,
What are the big takeaways from this letter from decades ago that are maybe even more important for us today?
Well, it really boils down to these 4 core principles. First, always look past the headline numbers to find the real economic story. Second, focus on businesses with durable advantages, what he calls moats, instead of commodity businesses where you're just stuck competing on price. Third, the real way to judge a manager is by how intelligently they allocate your capital, not just how big they can make the company. And finally, never forget that even the best business in the world can be a terrible investment if you overpay for it.
In the end, Buffett's entire philosophy in this letter really comes down to this one powerful idea. The real job of a leader isn't just to make the business bigger, it is to make each individual share of that business more and more valuable over the long haul.
And so this letter from 1982 leaves all of us with a really profound question. Whether you're an investor, a manager, or just part of a team, you've got to ask, are the things we're measuring the things that truly matter? Because as Warren Buffett proved, sometimes the most courageous and smartest thing you can do is throw out a broken ruler.